Hello traders, welcome to another daily analysis. Today is Monday. Right now it's around 6 p.m. Eastern Standard Time, December 19th. So we officially is into our last 2 weeks of December, and of course, because of the thin liquidity and last 2 weeks, not only the thin liquidity, the reason is a lot of traders taking vacation, and before they takes their vacations, they are going to close their position. So you're going to see a lot of profit taking, and that will actually reverse a lot of strength into the currency market. That's why sometimes in the last 2 weeks, things start to become a little bit funny. It's because you just start not really able to see a clear direction. And the reason is because you have, irregular amount of profit taking. People really pretty much want to finish up the year, and you have to look at their institutional traders' point of view is that they have to produce a very nice report for their clients. So it's really no point for them to keep making that last few trades for the year, because if they have a winning year, that's it. If they have a losing year, then that's also it. If you are professional, then you're not going to really risk too much at the end. It's really, if you do that, it becomes like gambling. It's like, oh, I've been losing for all years, so let me make it back in this one last shot. I certainly committed that crime before when I was relatively green back then, but nowadays, if I have a negative year, just let it be. In terms of trading, you're not going to have a winning year for every year. So if you have a negative year, it doesn't matter what happened. When it approaches the end of the year, I tend to just wrap up my daily trade and also reduce my position. So I still trade time to time, depending on if I'm taking vacation. If not, I still trade. I still like to get into the market, but all my position will become intraday. All my position will become smaller positions. So let's take a look at our daily analysis today. I'm just waiting for my Evernote to work. Alright, so there was no major news over the weekend, and today was another usual Monday with light economic data in both sessions. Now, as mentioned, I just said the last 2 weeks of December. So I personally take small position with 0.2% per trade. So that's how small my position is. If I take any trade in these last 2 weeks, it's 0.2%. Now, London session, we did have the German IFO business climate, which is not really a tradable event, but it came out as positive. So, of course, support euro dollar a little bit, as euro dollar is very bearish from last week. The two reasons: first is because the ECB, the continue easing programs, also because the Federal Reserve finally raised the interest rate. So in these two compound elements, and then you see a lot of selling into euro dollar, but that might very well change in these 2 weeks. As mentioned, people are taking profits. And in the New York session, there was no major data. Asian session later on, we will have the monetary policy meeting minutes from RBA. That's gonna affect Australian dollar, and the policy rate from BOJ, Bank of Japan. Now, of course, these two events are expected to be non-event, just because they don't expect to do too much change for these two central banks. So the expectation is that the monetary meeting minutes from RBA will be positive, as Australian is doing quite well actually recently in the last quarter of the year. Everything's very well supported, and the China economy is continue to grow somehow, relative speaking, in comparison with other major countries. So that's support Australian dollar. So they expect the monetary minute to be positive. Now, if it is positive, then of course there's nothing to trade. If it's negative, it's still not a reason for me to sell Aussie, right? It just maybe provide better level for you to buy Australian dollar. Now, Bank of Japan, the interest rate, of course, expect to be on hold. Everything is expected. The buying program is expected to be hold, but people really just want to look out their future directions. What are they trying to do in terms of the stimulus programs? So that's what people are expected to see. Of course, you do have a lot of past experience that the Bank of Japan surprisingly raise the interest rate or cut the interest rate. So you do have that kind of event. So never say never, So of course, if they cut the interest rate, then that's another chance to sell Japanese yen, which is already a weakened currency to sell. If they actually have a hawkish tone, then of course that's maybe for me personally not a reason to buy Japanese yen, but again maybe a better level to buy dollar yen. Sentimentally, the WTI climbed up again today, and the equity market were mixed for today, which is not a surprise. So right now the sentiment, I gotta tell you, it's still the same. We still expect a strength in US dollar, New Zealand dollar, and Australian dollar. We still expect weakness in the Euro, Swiss franc, and Japanese yen. British pound was a mixed currency right now. It's really hard to tell where it's gonna go, especially we are approaching 2017. So expect next year, the first quarter will have a lot of headline about Brexit. Then that's gonna create a mix of sentiment day to day for British pound. So I don't want to get into British pound at all from now on, because it's just hard to find out a long-term directions, and as a swing trader myself, I don't want to get into this kind of choppy movement. I actually did bought into British pound last week, and of course got stopped out. So that's for me. I don't want to get into British pound from now on until next year, and we'll see what happens to the Brexit. But just expect there's going to be more headline, and when I say headlines, it's not really going to be negative or positive, and that's the problem, because sometimes you will have a positivity coming to British pound, sometimes you might have a negativity, and the thing might come different every day, and that's why it's hard to trade for me personally. Canadian dollar is positive versus weaker currency, so you can still buy Canadian dollar versus Euro, Swiss franc, and Japanese yen, and the reason is because the oil market is still well supported. Now the only risk for the oil market is the volatility. It's not the direction. Now right now we all know that the direction is going to go up, but it's not going to be a straight line. So from time to time you're going to have a lot of pullback, and that's going to weaken Canadian dollar. So that's really the only risk when you trade in Canadian dollar. It's just watch out for this kind of day-to-day movement. A lot of people will actually ride on the right direction, but get stopped out because the movement is too large. Then you get stopped out, unfortunately, and then it goes to your direction again. That certainly happened to me. So, if it's hard to trade, then you don't need to trade Canadian dollar. But in the general direction, it is still going to go with the oil market, which is going to go up. And as mentioned, that's it for these last 2 weeks of 2016. And the risk, again, thin liquidity. That means that the trade might not go anywhere, and you certainly don't want to lock into a trade way over the holiday season. Second thing is the profit taking will sort of switch the underlying strength and weakness in terms of currency. But if all things are equal, we are still looking to long dollar yen, dollar Swiss, Aussie, New Zealand CAD. We're still looking to long these few pairs. We're still looking to short. Now, personally, what I do is I don't trade daily trade anymore in these last 2 weeks. I actually go into 4 hours. So I go to 4 hours, and you can have. Oh, what happened to the chart? It's a bit weird. Let me pull something normal. Okay, you can just pull out a simple trend line, and you can even just do with candlesticks. But the point is the position. That's the most important thing, the position size. Now, personally, when I trade, sometimes I tend to focus so much on the strategy, and a lot of people are doing that too. So you tend to make a decision whether to take a trade or not based on the strategy. And there's nothing wrong with it, because when we're doing back testing, when we are doing a lot of practicing, we actually really focusing on whether the trade is good enough to take. But in reality, a lot of time the trade is valid, but maybe you're just not that confident. Now, in that case, you don't really have to make a black and white decision to say, oh, I have to take a trade or I don't want to take a trade. You can just reduce your position or increase your position. So really play around with the position size it's really a more solid way to trade for myself, because a lot of time a signal might not be perfect, or a lot of time there's just so much circumstances, so much risk that is uncountable. So I still want to take a trade, and at the moment of that kind like that, I will just reduce my position size. So I tend to actually play around with the position size, and really I go with my psychology, because if I force myself to take a full position, which is my usual position, I know that I'm against my psychology. I know that I'm too afraid, or like I'm losing my sleep, things like that. If I reduce the position too much, then I don't really pay that much attention, then I know that I'm taking too small position. So it's really you have to experiment it. But what I'm trying to say is that that's another thing you can play around, is the position size, and it might be a good thing to try. If you are very good at strategy, you can really play around with your position size. Understand that the trading is very dynamic. So the more you are in the market, you understand that, hey, you can actually take a trade. It doesn't have to be perfect, strategically speaking, but you can reduce your position size, or you can increase your position size per se to play around with the market. So my previous